Hello, and welcome to what I believe is going to be a four-part series. We'll talk about algorithm theory and construction. Now, it's important first off to talk about what an algorithm is and what it can and can't do in the context of trading. Now, you can get very, very complex with algorithms. If you want to learn Python, and you want to learn how to analyze stocks, you want to learn how to analyze markets, you want to learn how to do machine learning, all that sort of stuff. And this is all stuff that I do. It's great. It's wonderful. And it's not quite where you want to start. And if you're watching this video, you're probably looking to find a place that you can start. So we're going to go quite a bit more basic. So first of all, you're going to have to determine what type of software you want to use, what language you want to use, that sort of thing. For the basis of this, I'm going to be using what's on the screen right behind me, and that is TradingView. TradingView has a built-in language called PineScript, and it's actually very fully featured. It's a very good language, and TradingView's built-in backtesting engine is quite powerful. Now, you can get backtesting engines other places. You can write things in different languages, but I recommend TradingView to the person who's starting out learning algorithms, just because it's kind of like all a contained package. And don't worry too much about learning PineScript. Now you might be thinking, well, why would I learn PineScript when I could just learn Python, for example, right? The fact of the matter is that Python and PineScript are quite similar. So you're not wasting your time learning PineScript. I promise a lot of the syntax transfers over to Python. So in the rest of this video, let's talk a little bit about the concept of a trading algorithm. Now, in my opinion, there's three parts to it. You have to open the trade, you have to manage the trade, and you have to close the trade. So opening the trade is more simple than people think. All you need is a very slight advantage. Think 51% to 49% when you open the trade. It can be something as simple as the ADX MACD confluence indicator that I made. And that indicator is available for free, so you can go look at how it finds trades. And in fact, the one that's on the screen behind me, and we'll be diving into it a little bit more in these videos because it's a good example, is the algorithm based off of that indicator. So when we talk about opening, and again, I'll use that as the example here, when we find that confluence between the ADX and MACD, that's our opening cue, all right? It gives us just a slight advantage, and that's all we want for the opening. Or it's all we need anyway. The higher the advantage, the better, but it's all we need to get a successful algorithm. And most of what is going to take your algorithm all the way is done in management, not in opening or closing. So it's actually going to be pretty simple to open trades. There's no real need to overthink this. It doesn't have to be an extraordinarily complex strategy. All of my algorithms are based off of something relatively simple, or it's a few factors combined together based on how the user wants to set up the algorithm. It's usually something very simple though. And again, that's a good example, the ADX MACD. Now, in some of my algorithms, including this one, I have auxiliary opening ideas. For example, the cumulative volume delta indicator that I have. If the indicator is not showing that volume is moving in the direction that the ADX MACD confluence is found, then it won't open the trade. It's just another way to filter out trades that we don't want, right? I've got another one that's built into my algorithms that works off of volatility. If the underlying stock is not volatile enough, it won't open the trade, because a low volatility stock generally is not one that you're going to want to day trade, right? Because it's just going to be kind of moving sideways. And that's not really incredibly useful for us, at least as far as day trading algorithms go. So that's another example. It's good to have your main opening strategy and then a couple other little filters that you can apply to it. And that sort of thing is especially useful, like in my case, for example, because one of my filters is volume, and not every asset is going to have volume. For example, Forex generally doesn't present with volume. So you need something else to be able to filter out trades, and that's where something like a volatility filter can come into play. So once your trade is opened, it comes down to management, and management is what's going to make or break you. I am kind of under the impression, with all the work I've done in the market, that you can virtually open a trade at random, and as long as you have proper management, you can end up being profitable. That's just due kind of to the nature of the markets and how they work. But if you have a small advantage in your opening and you have good management, then you're going to end up with 80+% win rates, which is generally what I'm looking for. 80+% and 3.0 or higher for profit factors is generally what I'm looking for. The one behind me is about that. So with your management, you need to have stop outs, obviously. And I like to use break-evens. So when the trade reaches a particular point, it will then change its stop out to be from below entry, right, to the entry price, or even a little above it, if I'm going to use an offset break-even. Those are built into all my algorithms as well. So for example, if I open a trade at $10, the break-even's at $11, it goes up to $11. Now it's going to move its stop up to 10, or if I have an offset break-even, say like 10.15. So if it comes all the way back down, it'll still keep a tiny bit of the profit. Offset break-evens are going to help your win rate by a lot, and it's going to help your profit factor by a lot. So here's another thing about offset break-evens. When you're talking about algorithms and trading like this, especially with our Trade Connect software, you can see some slippage, because depending on how it's programmed and what software it's running through, it can take a couple hundred milliseconds to conduct the trade. And in that amount of time, you can see a little bit of slippage. So offset break-evens become even more important. And don't worry, we're going to dive into that stuff a little bit more in depth as we go along. So you get to learn a little bit more about that. And the last thing I'd like to say here about, actually two more things I'd like to say about management. The first is going to be your take profit points. There's different ways to do take profits. Now, my algorithms use proprietary code that I came up with, so I'm not going to tell you how I do it. But it tends to capture peaks and valleys really well. So the stock will shoot way up if I'm in a long, and it'll get within a couple bars of the peak. It does really good. But again, I'm not going to tell you how I do it. It's mine. You got to come up with your own method. But coming up with a way to take profits during the trade is crucial. You have to be able to take profits during a trade. You have to be able to take your trade off in tiers. Very, very crucial. Whether you're manually trading or algorithmically trading, you have to be able to take some off the table, because that A is going to cement in profit, and B, it's going to lower your risk on the remainder of the trade. So it's very, very important to be able to do this. And the last thing I'll say about management when it comes to stop outs, break evens, taking profits, that sort of thing. These numbers, in general, need to be variable. So what that means is they have to be built to take advantage of the volatility in the stock. Because if I'm trading a stock like XOM, it barely moves throughout the day. I mean, if that thing moves like 20 or 30 cents, then that's a big move for that stock. Same thing with like Bank of America, BAC. If that thing moves 20 cents, that's a big day. So using static numbers, while these are built into my algorithms, because you can set them on individual stocks sometimes, and they work fine. Using static numbers in general isn't the best practice. So you need to have a way to vary your stop outs and your take profits, your break evens, using stock volatility. There's different ways to do that. There's different ways to measure volatility, and we'll get into that a little bit, like I say, a little bit more later on. But it's very, very important. So don't just have a trailing stop loss with a static amount of money. It's not going to perform well. Now, you may find instances where it does, actually. But in general, like if you're trying to design your algorithm to be used across different tickers, different time frames, like all of mine are, I can use them on pretty much any ticker or time frame. Being able to adjust to the stock's volatility on the fly, so that's built into the algorithm, is the way to go. You don't want to just use static numbers. So that's it about management. We'll talk about closing a little bit. Closing is generally different than simply stopping out. Okay, I put stopping out, and then again, this is just me. I put stopping out under the category of management, whereas closing is going to be a little different. Okay, so we have our opening condition. We'll say, in this example, we get our ADX MACD confluence to the long side. All right, pops a buy signal, and we're into the trade. The closing signal on that could be, for example, the ADX MACD confluence hitting in the opposite direction. That's not a stop out. It's not a take profit. It's not a break even. What it is it's just simply, this trade is no longer viable, so let's exit the market. You need to have a closing condition. There will be times when your algorithm takes a couple of profits and then it finds a closing condition. That's a lot of the trades, honestly, is taking a couple of profits, finding a closing condition, and you're out. So this is different than stopping out. You could do some sort of trailing stop loss as your closing condition, and that might work on some particular tickers, some particular time frames. Personally, I don't like it. And algorithm creation is a really personal thing. Once you find something that works for you, you tend to stick with it. At least I do. So that's how I like to program my algorithms. We have an opening and closing condition, and they're usually fairly similar. They're based on similar things, and then we have management throughout the trade. So that's kind of an overview of what we're going to talk about in the series: opening, management, closing, and we'll talk a little bit about learning how to program these things. And we'll look at the TradingView backtesting engine a little bit. And we'll talk about some of the inherent difficulties with that backtesting engine. And I'll show you how you can use your custom algorithms in TradingView to trade automatically. And that's going to be hooking up to some software that's just about to launch. Depending on when you're watching this, it may already be available. It's called Trade Connect. And you can hook up to a few different brokerages to trade futures, shares, and crypto, and options are coming. So that Trade Connect software, you can hook your algorithm directly to. You can trade automatically straight from TradingView. So yeah, stay tuned for the other episodes, and take care.